Most traders believe this pattern is their direct line to institutional money, a clear, undeniable footprint left by the giants of finance, signaling a high probability entry. They believe this with absolute certainty, and in 99% of cases, this belief will lead them directly to ruin. The logic seems flawless. A large institution needs to accumulate a massive position without moving the price against itself. So it works its orders in a tight range, a block, before igniting a powerful move. Retail traders are taught to wait for a return to this origin point, this sacred ground, to join the smart money for the next leg up. It's a clean, compelling story. It is also a dangerous fiction. To understand the illusion, one must first abandon the romantic notion of a single, human entity making a decision. The market of the 1990s is gone. Today's battlefield is not operated by people in colored jackets. It is a digital ecosystem dominated by competing algorithms executing millions of orders per second. These algorithms do not leave footprints. They weave traps. The story of the order block hinges on the idea of a large, unfilled order waiting patiently at a specific price level. This is a fundamental misunderstanding of modern market mechanics. A Tier 1 institution looking to buy 100 million euros does not place a single, static limit order. It deploys sophisticated execution algorithms, tools like TWAP and VWAP, designed for one purpose: to accumulate a position with zero market impact, to become invisible. They slice their intentions into microscopic pieces, scattering them across time and multiple exchanges. They hide behind iceberg orders. They seek dark pools, private exchanges where massive transactions happen completely shielded from the public eye. The very concept of a single, identifiable block of orders left on a public exchange is anathema to their entire operational security. They actively work to avoid the very pattern retail traders are searching for. So, the critical question emerges. If institutions are designed for stealth, what is this pattern that so many traders call an order block? What is this recurring, chartable phenomenon that looks so much like a footprint? The answer lies not in accumulation, but in engineering. It is a carefully constructed mirage, painted onto the chart by a different kind of algorithm altogether. This is the logic of the market maker and the high-frequency trading firm. Their primary objective is not to take a long-term directional position. Their objective is to generate volume and capture the spread. And the most efficient way to do that is to create liquidity, or more accurately, to harvest it. Every trading decision leaves a residue of data: a buy stop, a sell stop, a stop loss. These are contingent orders, dormant instructions waiting for a specific price to be touched. For a market-making algorithm, these pools of stop orders are not just resting liquidity, they are a guaranteed source of revenue. They are a target. To activate these orders, the algorithm needs to push the price into these well-defined zones. But the real power of this mechanism is not simply in triggering obvious highs and lows. The true artistry lies in creating new liquidity pools where none existed before. It requires inducement. It requires a story. It needs to convince a cohort of traders to all place their stops in the same predictable location. And what better story is there than the myth of the institutional footprint? Let us deconstruct the anatomy of the trap. The algorithm first identifies a market context where traders are likely looking for a reversal. It then engineers a sudden, sharp move down, a move characterized by significant volume and displacement. This move is aggressive, visceral. It is designed to look like a powerful entity showing its hand. This manufactured price leg creates the final down candle before the expansion up. To the trained retail eye, this is the birth of a bullish order block. The pattern is now set. The signal is clear. Forum posts and YouTube videos have conditioned the response. Traders dutifully mark the high and low of this candle, set their entry alerts, and prepare to buy the pullback. Their logic is sound. According to the textbook, they are following the smart money. But the algorithm is not building a position. It is building a narrative. It is baiting the trap. The order block is not a zone of support left by a friendly giant. It is the precise, calculated kill zone for a liquidity-seeking machine. As price returns to the perceived origin of the institutional move, the buy limit orders from retail traders are filled. The algorithm, which engineered the move in the first place, is now happily selling to these buyers, creating a balanced book. But its primary objective is not yet complete. The real prize lies just a few ticks lower, a concentrated, dense pool of stop-loss orders, the collective financial pain of every trader who just bought into the illusion. The algorithm has now painted the signal. The retail traders see an institutional entry, but what the algorithm sees is something else entirely. a precise calculation of inducement, a pool of stop-loss orders ripe for harvesting. And its next move is not to respect the block, but to annihilate it. In an instant, the narrative shatters. The institutional support vaporizes. The carefully placed stop-losses trigger a cascade of market sell orders, driving the price down even faster. For the traders who followed the pattern, it is a moment of pure cognitive dissonance. The footprint they were told to trust has just turned into a bear trap. The trade is a failure. But this is where the story you've been told ends, and where the truth actually begins. Because here is the question that changes everything. Why? Why would a multi-billion-dollar high-frequency trading firm, with access to the most sophisticated technology on the planet, expend so much energy and computational power just to hunt for the stop-losses of a few thousand retail traders? Is that truly the endgame? The answer is no. The retail liquidity, while profitable, is not the prize. It is the bait. You, the pattern-following trader, are not the primary target of this elaborate deception. You are merely the catalyst, the blood in the water, the engineered move, the creation of the order block, and the subsequent violent run on the stops below it creates something incredibly valuable to a different kind of predator lurking in the digital shadows. It creates a short-term, predictable pocket of volatility. The stop cascade is a guaranteed, high-velocity move in a specific direction. This is the second player, the hunter that hunts the hunters. These are algorithms designed not to engineer liquidity, but to profit from these manufactured dislocations. They don't create the story. They read the subtext. They see the induced order block form. They anticipate the stop run, and they position themselves to profit from the aftermath. The overextension, the market's panicked reaction. They buy the carnage that the first algorithm created, anticipating the snapback reversal once the artificial selling pressure is exhausted. What you see as a stop hunt is, at a higher level, a complex dance. It is a war between competing algorithmic strategies, playing out in microseconds. The first algo baits the trap for retail, and the second algo baits the trap for the first. So that chart pattern, that order block, it's not a footprint. It's a battleground. It is the geographic location of a planned conflict. It's a symphony of deception, where one set of machines creates a false narrative to harvest liquidity, which in turn creates a predictable anomaly that a second, faster set of machines is built to exploit. Retail traders aren't just fighting the house. They are caught in the crossfire of a war between gods they can't even see. The very signal designed to lure you in is simultaneously a signal for another machine to take the other side of the trade, not against you, but against the entity that lured you in. But let's pause. Does that war actually make sense? Why would one machine create a profitable dislocation only to let a competing machine instantly exploit it? What if this isn't a war at all? What if the hunter and the hunted are merely two arms of the same colossal beast? Think about it. Not competition, but choreography. One process creates the perfect, artificial sell-off. Its sibling process then creates the perfect, artificial recovery. The institution isn't just taking one side of your losing trade, it's manufacturing and profiting from the entire round trip. They aren't hunting your stops. They are farming volatility. The entire pattern is a self-contained, liquidity-generating event, designed, executed, and closed by a single, unified intelligence. The market isn't a natural ecosystem. It's a closed terrarium, and you're just part of the weather. So, what does this mean for you, the trader? Alone with your charts. It means the game is not what you were told it was. The search for the perfect pattern, the hunt for institutional footprints, it's a fool's errand. You have been trained to read the tracks of a ghost, a story manufactured to create a predictable outcome for its author. You are not reading the market. You are reading the script it has been given. But this realization is not a reason to despair. It is a reason to evolve. It is the beginning of true sight. Because once you stop trying to guess the next move in the puppet show, you can start studying the puppeteer. You stop looking for footprints in the sand and start looking for the tide itself, the ebb and flow of engineered liquidity. The goal is no longer to predict where the ball will land. The goal is to understand the physics of the machine that throws it. To see the buildup of retail orders not as support or resistance, but as fuel. To see a clean order block not as a point of entry, but as the coordinates for a planned detonation. You shift your focus from pattern recognition to liquidity engineering. You start trading the machine, not the market it simulates. This is the paradigm shift. This is the difference between being a pawn in the game and an observer of the board. The system is designed to be a black box, a puzzle with no solution. But by studying its behavior, its rhythms, and its ravenous appetite for liquidity, we can begin to map its internal logic. We can't beat the machine, but we can learn to move between its gears. The story you've been sold is a lie designed to make you predictable. The truth is far more complex and far more fascinating. If you're tired of playing a game you were designed to lose, if you're ready to stop chasing shadows and start mapping the machine that casts them, then your real education begins now. Subscribe to Trade_Logic_Lab, and let's decode the system together.